Good afternoon, everyone, and welcome to our tax webinar today. Thank you very much for joining us. My name is Junaid Usmani.
I'm Hassan Soel.
I'm one of the co-founders and partners of SRJ Chartered Professional Accountants, and we're honored to have you with us today. Today, we're going to be doing a little bit of a presentation, a tax 101 for entrepreneurs. And give me 1 second, I'm just going to get my presentation locked and loaded for you all to join us or for you all to follow. All right, excellent. So on our agenda today, we're going to start off by talking a little bit about various business structures that you can have as an entrepreneur. So whether it's a sole proprietorship, a partnership, or a corporation, we're going to dive a little bit into the benefits, the pros and cons of each. We're also going to talk about owner-manager remuneration and how to compensate yourself, or rather pay yourself from your corporation, salary, dividends, what's the best way to optimize your taxes. From there, we're going to move on to tax-deductible business expenses. What can you pay through your business? What can you not pay through your business? Another topic that's near and dear to my heart, how to plan and save for the purchase of your first home. Those skyrocketing housing prices all across the GTA in Canada, I know it has a lot of people worried and oftentimes concerned about how they're going to budget and save for their first home. So don't worry, we got you covered. We're going to talk to you about the most tax-efficient way to get you there. And lastly, we're going to talk a little bit about some of the SR&ED program or government incentives, as well as some financial tips and best practices. And then we'll try to open the canvas for some Q&A at that time. So now I'm going to pass it on to Hassan, who's going to talk to us a little bit about some of the various business structures that you can have.
Perfect. Thank you very much, Junaid. Again, good afternoon, ladies and gentlemen. So one of the first business structures is a sole proprietorship. So, first thing is, what is a sole proprietorship? So sole proprietorship is essentially a single owner managed business. It is the simplest and most common form of business that's found in Canada. It's normally suited for a lot of small businesses, freelancers, consultants, basically anybody that has low risk and minimal liability exposure. Sorry. Perfect. Perfect. Okay. Oh, sorry, I lost my. There we go. It's suitable for small businesses, any freelancers, any consultants, anybody who has limited liability and exposure. It's also great for startup businesses that are in their early stages and they're trying out new concepts, new products or what have you. So some of the features of it is very easy to set up because there's minimal paperwork and very low startup costs. And as the owner, you always have direct control because you're making all of the business decisions. And in terms of taxation, a sole proprietorship is taxed on your personal income tax return, which actually leads me right into some of the advantages. So again, because it's personal taxes are relatively simple and incur lower compliance and tax filing costs, it is cheaper and more efficient to get a personal tax return filed. And in addition, if you're losing, when you're in the infancy stage of your business, you could potentially be losing money. And if that's the case, you can use that business loss, the loss that the business generates, to offset other forms of income. So if you have investment income, if you're still employed while you're doing this, you can reduce that. You can reduce taxable income on that and end up saving, some tax money. Some of the disadvantages, because it is 100% owner managed and owner owned, your liability is unlimited. So what that means is, if creditors come after you, if you get sued, they can come after your personal assets. The other major disadvantage is the tax burden. So because you're taxed on your personal tax return, you pay tax on your marginal income tax rate. So the more money that you generate from the business, the more taxes you ultimately end up paying. So this leads us right into partnerships. So partnerships very similar to sole proprietors, except that they're owned by two or more individuals. They're also governed, generally there should be a partnership agreement in place that governs how the partnership will operate. This form of business is very common in professionals like lawyers, accountants, doctors. A lot of those professionals end up using, you likely see after a lot of law offices, it says LLP or accountants, for example. So we'll talk about the major types of partnerships. So there is a general partnership, in which all partners have equal responsibility for management, debts, liabilities, and they're personally liable for the obligations of the partnership. A limited partnership includes both general partners, like I just mentioned, who manage and are liable for the business, but it also has limited partners, like investors, who have limited liability and no management aspect. And the last type, which is the LLP that I was actually just referring to, is a limited liability partnership, which is very similar to a general partnership, except that the partners are not liable for one another's negligence or misconduct. They're just liable for themselves. So some of the advantages of this type of structure. So with more partners, obviously means you can share responsibility, you have more intellectual capital, more decision makers, more people to kind of have a say in how things can get done. With more people comes an increased access to capital, more money that you can tap into, the business can grow exponentially more quickly. Unfortunately, some of those lead right into the disadvantages where there is a potential for conflict, right? If there is more than, you're not really the head chef, so to speak, more people means more opinions. More opinions means disagreements. And then, with that access to the increased capital, it also means that the profits at the end of the day also have to be shared. So just something to keep in mind in regards to that. So, we've talked about businesses that get taxed on your personal tax returns and, how that tax amount is so much higher. So what can you do about it? You can incorporate. So what are some of the benefits of incorporating, right? So liability protection. So I've already gotten into, if you are owner managed, you could be personally liable for anything that the business does. So when you incorporate, this creates a legal separation between yourself and the business, because the CRA sees the business as a standalone entity. What that means is that the owner is protected from the liability of the business. So if a creditor or any litigations happen, generally the creditors or litigators cannot come after your personal assets. The other amount I touched on is paying incremental tax and paying a lot more tax. So corporate taxes are taxed, the CCPC essentially, small businesses in Canada are taxed at a small business rate, which is 12.2%. So if you're incorporated, any money generated by the corporation, which is not drawn out by you personally, will get taxed at that 12.2% rate. So what that means is, until and unless you take a salary or a dividend, which then gets taxed on your personal tax return, you will not be paying that incremental higher tax. So, if the business generates $500,000 in profit and you only need $200,000 of that personally, that means $300,000 sits in the business for you until, a later time when you're ready to take that money out. That way you can build capital in the business, which can help you invest through the business, which can help you buy capital assets through the business. So it's really all very good in the tax deferral end of things. Last,
to add to that, Hassan, I think it's just so important to highlight what you just said, right? The fact that keeping that money in the corporation for a high income earner allows them to defer 40% tax when they're paying 12% as opposed to 53%, right?
Oh, absolutely.
So absolutely. In the head, and I think that it's a really good point. And oftentimes I tell our clients that's one of the main reasons you want to incorporate is to keep money in the corporation and defer that second layer, that 40% of taxes, right?
Absolutely. Like you said, especially for some of our more high net worth clients, like doctors that are bringing in, up to $1 million a year. If you're bringing that in on your personal tax return, like Junaid said, you're paying almost half of that in taxes, right? And you may not necessarily need all of it. And letting it sit in the corporation lets you save that tax until you're ready to use it.
Yeah, you can now invest it, real estate,
Exactly.
rental properties, stocks, bonds, mutual funds, a lot of fun things you could do with that money saved up in your corporation, right? So appreciate the insight there. Thanks,
absolutely. Man. And in terms of investing, even if you're investing and it's considered passive income and it's taxed at a higher rate, that's still, I believe, Junaid, correct me if I'm wrong, 38%, which is still lower than the highest tax rate on the personal end of things. So no, great points. The last point I actually want to touch on before we move on from the benefits is lifetime capital gains exemption. So when you incorporate as a proprietor of the business, when you sell the business down the road, the qualified small business shares, so the shares of the business, are exempt from capital gains up to the limit of that year. So I believe the limit for 2024, if I'm not wrong, is just over $1 million. So what does that mean? That means that when you sell your business, any capital gains up to that first $1 million mark is tax-free, which is excellent news, which means that you get to hold on to a lot more of that money before the tax man gets to it. Alrighty. So having discussed that, so, we're talking about saving tax in the corporation. So what are things that you can do to further reduce that tax liability? One of the things you do is you draw from it for your personal income. So ways that you can do that, we'll get into salaries. There's also dividends. We'll get into some income splitting and the rules that surround that. You can also reimburse yourself for expenses that you pay for personally for the business. Whether it's home office, your internet, your automotive, your cell phone. So we'll touch on that moving into the next slide there.
Yeah. Did you want to go through the salary dividends or go through the deductions first?
I think we can start off with the salary there, Junaid.
Okay, perfect. Yeah. So.
Just the next slide there.
Oh, sorry, this one here?
Oh, yeah, no worries. Perfect. Thank you. Thanks, Junaid. So, one of the simplest forms of taking remuneration from your corporation is a salary. So how the salary works is generally it's going to be about it's going to be the same amount on a monthly basis. Like for a lot of our clients, Junaid, we send out compensation plans, which outlines for them how much salary they're going to take and the deductions that are associated to it. So a lot of accountants, will do that for their clients. On that salary, you pay monthly payroll source deductions to the CRA, which generally consists of your Canada pension and your taxes. So some of the bigger benefits of paying yourself a salary is that it does let you contribute to the CPP program. So, when you retire, there is that guaranteed income. In addition, you can generate you will generate RRSP room, so that not only can you save for your retirement by investing, but you get that related tax deduction in the year that you contribute. So, in terms of dividends, so dividends can be a little bit different than salary where, you're going to draw it once a month, for example. Dividends can be taken throughout the year, however much or however little that you want at any given point. And then once we do your corporate tax return at the end of the year, we declare a dividend. So unlike payroll where, you're paying a monthly payroll source deduction to CRA, no source deductions or no taxes are normally paid on those dividends throughout the year. So what does that mean? That means you should set aside, a certain percentage based on, what tax bracket you might have been in the prior year, for example, or, what tax bracket you may end up in the current year. Save a percentage of that, set that aside to make sure that you have that money sitting around at the time of tax filing, because that's when you're going to owe this money, so that, there's no sticker shock, so to speak. Another thing we tell a lot of our clients is, if you'd like, start paying installments so that you don't have that large tax bill at the end. So some of the downsides there, though, you do not generate that RRSP room, right? So, you're saving for retirement by other ventures, but, you're saving yourself about $8,000 in CPP a year if you do dividends, right? Because you're paying $4,000 of the employee portion of the CPP. And because you're employed for yourself, you also pay the employer portion. Really, the way I like to think about it, if I'm thinking like salary versus dividends, is what's my end goal, right? So to kind of wrap up on that point, salary is more beneficial for somebody who wants to invest through tax sheltered savings like RRSPs and CPP and TFSA, where dividends are more geared towards, people who want to grow that wealth on their end and invest in real estate or other major asset purchases for retirement planning. That's kind of my points on it. Junaid, anything you think that we could add for our audience here to that?
No, I think you summed it up well, right? That's exactly what I always advise my clients, is that anyone that's looking to save for retirement using stocks, bonds, and mutual funds, the RRSP is important because that is a tax-free vehicle allowing you to grow those investments tax-free year over year. So if that's important to you, then you need to pay yourself more salary. But if you're, as you mentioned, if you're going to be looking to invest in real estate, or perhaps you want to just reinvest back in your business, or you're a serial entrepreneur who doesn't care about stocks, bonds, and mutual funds, then perhaps dividends is more a lean way of taking money out of your corporation, out of your business, paying less tax today, but being mindful that you're foregoing this RRSP contribution room every single year, that you're not paying yourself a salary.
Awesome. So we're just going to quickly touch on, thanks, Junaid. Sorry. We're just going to quickly touch on some of the more advanced tax planning concepts. And we're going to be going through these in a bit more detail moving forward, but just to kind of give you an idea, what's a shareholder loan? So shareholder loans allow you to borrow money from your business as long as it's returned to the corporation within one tax year. Otherwise, you have to declare a dividend. And then, anytime you pay for a corporate expense personally, you can reimburse yourself from the business through a shareholder loan. And then that expense essentially flows through the corporation and gives you a tax deduction. In terms of Holdcos, so these are generally related corporations that a lot of our clients will open up, and they can be used separately of the business. Protect your assets, defer taxes, and really is a lot of our clients facilitate estate planning through them. And then lastly, intercompany loans. So if you have related companies, whether it's Holdcos or other opcos, it can be used for cash flow management and tax planning purposes. Essentially, if there's excess cash in one corporation, it can be lent to other corporations within the same group, generally at a lower tax rate. So just wanted to kind of quickly highlight that before we move on to our next topic there. So, we've talked about paying yourself. So what about paying family members? Split that income, for example. So there's a few ways you can do that. You can pay your family members dividends, but it just depends. So in order to pay a family member, whether it's your spouse, whether it's your children, if you're going to pay them dividends, they have to be shareholders of the business. And it gets a little bit complicated there sometimes because certain jurisdictions don't allow non-professionals to be shareholders. So for example, if you have a dentistry corporation, a dentistry professional corporation, or a medical professional corporation, you have to be a dentist or a doctor in order to be a shareholder on that business. So just something to keep in mind in regards to that. And then, the other thing to think about is if everybody, let's say it's yourself and a spouse, if you both own the same class of shares, then that class of shares, everybody in that class of shares must get the same dividend. So, if you're looking to pay yourself a higher dividend and a family member a lower dividend, it's always a good idea to make sure that your articles of incorporation allow for those multiple share classes. So, if there's share classes for yourself and your spouse and they're different, you can pay yourself and your spouse a different dividend for that year. Especially when it comes to dividends, something to keep in mind are the tax on split income rules, so TOSI rules. Something the CRA has recently introduced is that, if you're going to pay a family member a dividend, they must contribute at least 20 hours of service to the business throughout the year. So it's kind of a check mark, so to speak. So if they've done that, a dividend can be declared to them at your discretion. However high, the CRA doesn't really care. If they have not done that, they will not allow you to do a dividend for a family member. And, just something you want to make sure that you've got all your bases covered in that regard. Before I move on to salaries, paying yourself salary, anything you believe, Junaid, that I might have missed touching on there with the dividends?
I think you did a good job summing it up. The one piece I'll add is, you were talking about certain professionals that can and cannot add, family members as voting shareholders, or as shareholders rather. So Ontario is one of those provinces where physicians, they typically could add family members as non-voting shareholders. Same with dentists in Ontario, but there are other provinces, to your point, where, we have to check the rules province by province, as many provinces do have restrictions where they may not allow family members to even be non-voting shareholders. And by virtue of that, if you're not able to be a shareholder, you can't receive that dividend from the corporation, right? So I think you covered the rest really well there. Thanks.
Perfect. Thanks, Sinead. So the other item that you could potentially be paying, a spouse or other family members is a salary. So really the rule of thumb with salary is that you want to make sure that, you have a contract in place that stipulates their job description, their working hours, there's, the amount of money that, the hourly wage or the annual salary that they'd be making. And you want to make sure that it is as close or similar to fair market value in terms of not only in terms of salary, But in terms of, their job description, you want to make sure the CRA realizes and sees that your spouse or your children are legitimate employees. Just so you make sure you cover your bases on that. And a contract is something that we always recommend to our clients to ensure that that is in place in case the CRA ever asks for it. And I've definitely been in situations where the CRA has asked us to legitimize that salary being paid to a family member. So just want to make sure we do everything correctly and cover all of our bases and have the correct paper trail. Awesome. So yeah, this was kind of our bit on the income splitting. We're just gonna perfect. Okay, so tax savings, right? So we were discussing about expenses that you can claim through the business. So the general rule of thumb I like to use is that if you've incurred the expense with the intent of helping your business generate income, there's a reasonable argument to be made that it is a business expense. Of course, unless it's specifically prohibited by the Income Tax Act. So, some of the things that the Income Tax Act won't let you deduct. Your golf fees and membership. So I know a lot of our clients are members to golf courses, and we have to give them that unfortunate news that it is not necessarily a deductible expense. Or clothing. I get this one a lot. Hey, I'm a lawyer. I'm going to buy a suit. I need it for work. Unfortunately not. It just depends. Like if you're a dentist and you're buying scrubs, okay, no problem. But the CRA is a little bit more stringent in terms of clothing. And then we get this one all the time. Hey, I bought some groceries. No, unfortunately, we cannot let you deduct that. With the way things are priced right now, Junaid, I would really wish that I could deduct my groceries, but CRA is just, and they'll come after you pretty quick on that one. So, so having said that, these are things that you can't deduct, but what are some of the things that you can deduct? So, just to kind of high level, some of the common tax deductions that we come across. So your membership dues for a professional association. So if you're an accountant, a lawyer, a doctor, really any professional that is paying those annual dues, those are definitely deductible. Salaries that you're paying yourself to other employees, to family members, or subcontractor costs, that's all deductible. If you're traveling for business, whether that's domestic or international, your office expenses, your cell phone, any meals. So if you're taking a client out for a meal or an evening out, that's a deductible expense. You're advertising your business, or the rent for your premises, that's all deductible. Insurance, so again, it just kind of comes back to that rule of thumb. If you can make the argument that this expense was incurred in the pursuit of generating income, let's discuss it. All right.
Absolutely. Great points there, man. And, I think, people tend to get kind of creative on this slide with what they can spin as a business expense. And oftentimes a lot of it is rightfully so justifiable, right? So if you think about advertising and promotion, like we have clients that are often putting gifts, and it's natural that in business, if you have, a good client, you want to send them a thank you, you might send them a nice gift card or a nice gift basket or something like that. So that's going to be, 100% tax deductible. One thing we would caution is, the meals and entertainment, as Hassan was mentioning, those are about 50% tax deductible, right? Because the CRA feels there's a personal element, a personal benefit that you realize on that. I will highlight that the CRA has been actively, looking into people's advertising and promotion over the last couple of years. I think 2021, 2022, I've seen a few of our clients starting to get routine letters from CRA just wanting to review those expenses. But, if you're giving out a gift, that could be something like a Raptor ticket, that may be 50% deductible, but otherwise, or if it's a gift card to like a restaurant, something like that, that's probably 50% deductible. But otherwise, all this stuff is what you can typically claim through your business as long as you can spin that there's a big business element to it. I just wanted to highlight a quick thing. So I've seen a number of questions come in so far, which is great. I appreciate all the engagement, and we will be coming back to address all those questions as best as we can as soon as we're, towards the tail end of the presentation. Moving forward from here, so other business expenses that we would commonly push through our businesses. So if you're someone that's often using your vehicle for business, if you're driving around seeing clients, or maybe you're working at multiple locations, you can claim a portion of your automobile expenses for business as well. One thing that's important to note here, however, is that the CRA does require you to maintain an automobile log for all the business use of your vehicle. Good news is I've been doing this presentation for a long time, and 99% of the people I work with or that I've talked to typically don't have a log that they're accurately maintaining at all times. But what I often tell them is, so long as you can go back and reproduce that automobile log, that's what's most important, right? So for myself, I don't keep a log, but I keep a very detailed Google Calendar. And any point in time, usually over the Christmas holidays, I'll sit in front of the computer, sit in front of the TV, and spend an hour or two, open up my Google Calendar, Google Maps, and figure out how many kilometers did I drive over the course of the year for business. If I determine that I've driven 3,000 kilometers for business out of a total 10,000 kilometers over the course of a year, I know I can deduct 30% of all my automobile expenses for business now as well, right? So now looking at these deductible expenses, if you are leasing a vehicle, you can write off now up to $1,100 plus HST of the lease costs. If you are financing a vehicle, typically you can write off up to $38,000 plus HST. And the government's actually introduced some really good incentives for anyone that's looking to purchase an electric vehicle. So if it's an EV, an electric vehicle, or what the CRA considers to be a plug-in hybrid, that upper limit to how much you can deduct as a business expense is about $61,000. And I'm going to put a caveat next to that because when you finance a vehicle, that's considered the same as purchasing the vehicle. Anytime you purchase what's called a major capital asset, we can't write that all off in 1 year. We would have to typically write that off over the useful life of the asset. So typically, something like a car, you'd write off 30% every year until there's nothing left to write off, right? But what's really great right now is that the government has this incentive going on just to promote investment within our country, whereby if you do purchase a vehicle or any capital asset, that could include computer equipment, manufacturing equipment, dentistry equipment, anything like that, dental supplies, you'd be able to expense 75% of those costs all in the year of purchase, as opposed to the 20 or 30% that the CRA would normally allow. So now back to these automobile expenses. I was mentioning that the automobile expenses must also be prorated. So gas, insurance, maintenance, parking, tolls, 407, these would all be prorated proportionate to the business use of your vehicle. So if I'm using my car 30% for business, then I can write off 30% of all these automobile expenses in the year. And one more point I want to clarify here is driving to and from one workplace does not typically count as business use of your vehicle. That's considered personal use of your vehicle. But if you're driving to a secondary work location, or if you're going to off-site to go visit a client or a patient, then that is considered business use of the vehicle for which you should be logging. So now,
just one point I wanted to add there, Junaid, regarding the log for automobile use. So one thing that I've been telling some of my clients is that there's a lot of great apps out there now. One that comes to mind is MileIQ, that'll let you, start a trip, when you're starting a business trip, and then end the trip, and then log when that trip was, what purposes it was for. And I have seen CRA accept those logs because you can just go right online after and you can print all those off, because to Junaid's point, having a calendar, that's all excellent and in itself as well, but just another tool to kind of add to your repertoire as well.
It's beautiful. There's an app for it. Of course there is, right? No, thanks for that. It's a great point. It's a great tip. So, similar to the automobile expense, if anyone is working primarily from their home and you have a dedicated workspace, you can deduct a portion of your home expenses as a deductible business expense, right? That's considered the home office expense. When this applies, you would determine this number of square feet or the approximate square feet that your home office is, and divide that by the total square footage of your home. So in my case, let's say I have a 100 square foot home office, and if I live in 1,000 square foot home, 100 divided by 1,000 is about 10%. So I'd be able to write off 10% of my rent, or if I own the property, my mortgage interest. Similarly, 10% of the property taxes, utilities, insurance, maintenance. When it comes to maintenance, that can include the upkeep of your home, such as cleaners, lawn care, snow removal, etc. Right? Even things like painting your home just to bring it back up to its original condition could be considered maintenance expense. Another commonly asked question that we often get is, Junaid, I'm looking to make a donation. Do I do this personally or should I do this through my corporation? What's the best way to optimize my donations, my charitable giving? Right? And I think that's a great question. What I often recommend is, in most cases, I do prefer that our clients, if they are incorporated, make their donations through their corporation. Generally speaking, what ends up happening is when you make a donation under your personal name, you only get a 20% tax credit for the first $200, and then everything above and beyond that, you get a tax benefit that's equivalent to your marginal tax rate. So in more plain English, like I find that you only get the full tax benefit when donating under your personal name if you're already at the top tax bracket. So usually it's just easier. A lot of your savings, a lot of your cash is already built up in your corporation. That's usually the best place to start giving from. Another tip that I often recommend here is that, actually, before I move on to that, I want to mention one more thing here. Another reason that it's good to donate from the corporation as opposed to personally is because personal donations, they're a bit more limited and restricted to they have to go to registered charities, or registered Canadian charities rather, versus when you are giving through a corporation, the CRA could be a little bit more lenient about that. And the reason for that is, if you were to give to, let's say, a GoFundMe campaign, you can make an argument that I'm doing this donation a little bit publicly to enhance my personal brand, right? Or my business's brand, as a matter of fact. So that can be considered an advertising and promotion expense. And it's a lot harder for the CRA to kind of dispute that. So from that perspective, if you are donating to a non-registered charity or something like a GoFundMe, or perhaps a charity that's not a Canadian charity, maybe a US charity or something outside of Canada, oftentimes I might recommend donating through the corporation just so that there's less likelihood the CRA may disallow that. Another way to optimize your taxes with your giving is to consider donating shares as opposed to cash, right? Because let me give you an example of an individual who bought shares of Apple for $100, and he did this 20 years ago, and now they're worth $30,000. So now if this individual is looking to be very generous this year, they want to donate all $30,000 that they have accumulated there. If they were to sell those shares of Apple and then make a donation, they're going to pay a capital gains tax on the sale of those shares. And if they made a donation separately, yes, they're going to get a good tax benefit. However, if they were to have donated those shares directly to the registered charity, they're going to get a full donation receipt for $30,000 benefit. So they're still going to get the full tax credit, the tax benefit that they're looking for. But now they're going to not have to pay tax on that almost $30,000 capital gain that they would have realized on selling those shares of Apple, right? So you save in taxes by not having to pay that capital gains tax. The charity is still going to sell those shares and get the full $30,000 in their hands. Charities are exempt from tax in Canada, so they're not going to be on the hook for any tax liability. And really, it's kind of like a win-win situation for both the charity and the individual giving there. I think it's a good way to optimize taxes. So consider, if you are looking to make some good donations this year, consider donating shares to a nice registered charity as opposed to giving cash. Oh, this is a topic that's near and dear to my heart. How to plan and save for the purchase of your first home, right? So we often get this, and I do, sympathize with people because, real estate prices have gone out of hand. It's not just a local problem, but, particularly GTA or, almost anywhere in Canada, it's gone very expensive, become very challenging for a lot of people to get into their first home. So oftentimes I have people coming to me and saying, Junaid, can I borrow money from my corporation to buy a house rather than take out money and pay tax as a salary? So can they take out a shareholder loan? Maybe. We'll come back to that. Can I purchase the home in my holding company? Not really a good idea, but we're going to come back to that as well. And then lastly, can I use my RRSPs or FHSAs to fund the purchase of my first home? Absolutely, and that's probably the best way to go. And I'm going to expand on all three of these in a moment. So we're going to start with the shareholder loans. When you have an incorporated business, a shareholder can borrow money from the corporation to purchase an automobile that they're using in the course of business, or shares of another qualified small business corporation, i.e. in plain English, just shares of another business in Canada. And then lastly, a home. Kind of, sort of, not really. And the reason I say that is because I know it sounds a little confusing. There is a section in the Income Tax Act that says shareholders can borrow money from the corporation to purchase a home. However, there have been court cases that kind of go against that. And what the courts have determined is that a shareholder can borrow money from the corporation to purchase a home such that it's a reasonable amount that they would be willing to offer any employee unrelated to them in their business to do the same, right? So what that means in more plain English is, if you're thinking about taking out $1 million from your corporation to purchase a home, would you be willing to offer $1 million loan to your secretary or your administrative assistant or anyone else that's working for your business? Probably not, right? So when it comes to borrowing money from your corporation to buy a home, it could be considered reasonable to borrow maybe $10,000 or maybe tens of thousands of dollars to purchase a home. That's considered fair game. But the higher that dollar amount goes, the more risk you run of that being considered unreasonable in the eyes of the CRA, right? So we don't typically recommend large shareholder loans from a corporation to purchase a home. Now, when it comes to holding companies, people often ask, well, why don't I just use my corporate money rather than taking money out and paying 40% tax? Can I just buy the home in my corporation? Well, corporations can lend money from one corporation to another, yes. You could purchase rental properties within your corporations, absolutely. But when it comes to your primary home, your primary residence, your home, I often don't recommend using a corporation to purchase the home. And the main reason for that is, first and foremost, one of the most powerful tax saving tools we have in Canada is the principal residence exemption. In plain English, what that says is when you sell your home, you're not going to pay any capital gains tax on any of that appreciation you may have realized on your home, such that you've been living in the home and such that that home is owned by you personally. You cannot own that home through a corporation and expect to use this principal residence exemption to reduce the capital gains tax on that sale, right? So for that reason, I often don't recommend using a corporation to purchase a home. The second important reason we don't recommend using a corporation to purchase a home is because there's also what's called a taxable benefit you will be required to pay if you are living in a corporate-owned asset. So what that means in plain English is if the market value rent I would pay to live in my home is about $5,000 a month, then for the rest of my life while I'm living in that house, I got to pay tax on this benefit that I'm not even really getting. I'm just living in this home, but this taxable benefit in the eyes of the CRA of $5,000 a month, that's the benefit I'm getting for living in a corporate-owned home or getting to borrow kind of a corporate-owned asset, if you will, right? So for those reasons, we don't like using corporations to purchase a home that you would be living in most cases, right? What we do like and what we do recommend is using the RRSP, which is the Registered Retirement Savings Plan, or the FHSA, which is your first home savings account. So now when it comes to the RRSP, an individual, actually before I get into that, when you put money into a registered retirement savings plan, consider this to be like a basket that holds your investments. It's just, it can hold cash, it can own stocks, bonds, mutual funds, whatever you want. And anything that's held by this basket can grow tax-free, right? So now the CRA says, you could put money into an RRSP and take money out tax-free to purchase a home. Typically in Canada, when you put money into an RRSP, you get a tax deduction. So let's say I made hypothetically $100,000 of income in a year, and then I dumped $60,000 into my RRSP. I'm only paying tax on $40,000 of income in that year, right? The net amount. So what that really entails is that means this $60,000 I've pushed into my RRSPs, I've actually deferred taxes on that $60,000 of income, right? So it's a pretty sweet deal that the CRA is offering us. They're saying you could put up to $60,000 into your RRSPs, avoiding tax when you put it in, and you can pull it out towards your first home purchase using the Home Buyers Plan, the program that the CRA has designed for this very reason. There's two conditions you must meet in order to qualify for the Home Buyers Plan. Firstly, the individual and or their spouse must not have owned a home that they have lived in for any of the 4 preceding calendar years. And secondly, the funds must have sat in your RRSP account for at least 90 days, or i.e. 3 months, right? So it does take a little bit of planning, but between an individual and their spouse now, if you have $60,000 each in your RRSPs, that's about $120,000 that you could have earned without having to pay tax on it in order to purchase your first home. Now, the next piece, the CRA, the government, more recently introduced a new program called the First Home Savings Account. It operates very similar, almost identical to an RRSP account. However, this can only be used for home saving for your first home. You can contribute up to $8,000 per year and up to a maximum of $40,000 per person in your FHSA, right? So if between you and your spouse, you each have $40,000 in your FHSA, that's about $80,000 combined you can withdraw towards your first home purchase. The same conditions apply between you and your spouse. You could not have owned a home in any of the 4 preceding years, and the money must have sat in this account for at least 90 days prior to the withdrawal to be eligible to be a tax-free withdrawal in this circumstance, right? So if you combine $120,000 between you and your spouse for the RRSP, and now $80,000 combined between you and your spouse for the FHSA, that's nearly $200,000 that you and a spouse can earn tax-free and put towards your first home. So to me, that's the best way to save for your home, is using the RRSPs and FHSAs. Last point I'm going to make here is, this is something that, purchasing a home is the biggest financial decision you're going to make in your life, right? And you want to make sure you do take time to plan that well in advance. So take advantage of those RRSPs, take advantage of those FHSAs. If you are incorporated, the last thing you want to do is stockpile all this money in a corporation and then one day come to your accountant and say, Junaid, I have $400,000 saved up in my corporation. I need to take it out tomorrow to buy a house. I'm going to say, nope, that's not a good idea. What we should have done is we should be taking out $100,000 from your corporation each year. And then over 4 years, we can build up savings of $400,000. You're going to pay much less tax in doing that, as opposed to trying to structure it in a way that allows you to just, pull out this lump sum at the 11th hour. All right, so we're almost wrapping up. A couple more things we're just going to bang through real quick. For any businesses that are involved in R&D, there are some really good programs out there. There's a program called the Scientific Research and Experimental Development Program. The acronym in the world of accounting and tax is SR&ED. You may have heard that term before. The SR&ED program is one that it really promotes innovation in our country. The government wants to promote, companies doing this type of R&D work. They want you to, try to advance science, advance technology, do innovative thinking or innovative, solutions to problems you may incur in your line of business. So if you are doing some form of systematic trial and error to overcome any obstacles or challenges or problems that you incur in your business, you may qualify for these SR&ED tax credits. And in a nutshell, what that means is you can get back up to 55 to 65% of the salaries you pay yourself and or any of your R&D team to advance the science or technology or improve processes in order to further your business, right? And even if your business is not one that's making money, these are fully refundable tax credits, right? So it's almost like a grant. It's going to be fully refundable to your business. You will get it back so long as you qualify. It is a little bit of a complicated, process. So that's where we often do recommend work with professionals that can help you with this. In-house, we do have a great associate partner that we brought in that specializes only in SR&ED and these type of government programs. So I have a list of government grants that are available for entrepreneurs here as well. I'm not going to be able to go into each one in full detail, but in general, if you're doing anything on the R&D or innovation side, typically there's a lot of good funding available for that. Similarly, when you're looking to hire people that are considered to be youth or sometimes minorities, oftentimes there's good programs for that. If you're exporting your business, you're looking to expand out of Canada, there's export grants. If you're looking to train, apprentices or youth, there's training grants available for businesses doing that stuff as well. If you're looking for, this slide in particular, feel free to drop any of us an email and we'll be able to send you some follow-up material on this as well. All right, so just to kind of, before we wrap up, a couple cash flow challenges, a couple tips on addressing cash flow challenges. One thing that's been great for us is, trying to automate invoicing, trying to come up with, using technology as your friend. So offering clients the ability to get a little bit of a discount sometimes for making early payments may help address some cash flow challenges in your business. Make sure you're often monitoring your cash flow. That often is one of the biggest challenges for many businesses is just maintaining good cash flow in their business. When it comes to your payments to CRA, I often recommend, set it and forget it. Automate your payments to the CRA, go into your online banking. CRA is typically looking for, installments. So just try to be ahead of those to avoid some nasty, unexpected, interest or penalties for not having made payments on time. When it comes to people that are new to business, I often recommend make sure you're separating your personal bank accounts from your business bank accounts, right? So get a separate bank account for your business, get a separate credit card for your business as well. At the end of the year, when you're looking to sit down and do your bookkeeping and your record keeping, it's going to make your life a million times easier. Rather, if you want to, offload this to an accountant, rather than having to highlight transactions and send them, a summary of your expenses, you can just flip them 12 months bank statements, 12 months credit card statements, and let them figure it out from there. Bookkeeping softwares we often do recommend are QuickBooks Online, QBO, or Xero, even Wave Accounting. Wave is a little bit more simple, so we typically recommend QBO or Xero for more robust businesses, as these are a little bit more powerful in terms of tax softwares. In terms of the app stack, so we talked about QuickBooks Online. Dext is another software I'm going to quickly highlight here for you folks. Dext is one of those softwares that allows you to take, snap a photo of an invoice or receipt from your phone, and it will automatically upload to the cloud, sync it to your QuickBooks Online account, find the transaction, and just link it right there for you, nice and neat for you. WagePoint is good for anyone that's looking to process payroll for their employees. Pluto is excellent for anyone that's looking to process payments to, vendors, or perhaps you can even use this to have one of your admin to set up payments for you and your team. And Pluto does have different authorization levels, so you can set it up where your admin can set up all the payments for you, but everything needs an approval. So all you got to do is go in and tick all the payments you want to approve on behalf of the business. Payroll and HST come with hefty penalties, so please make sure you're on time, on the ball with those. Same with the filings and payments. The CRA is currently charging 8% interest on any late payments. So again, try to be on top of that as best as you can. All right, so we're mainly wrapping up here. I do see some questions, and we are going to get to the questions and answers right now as well. Before I move on to that, I just wanted to highlight one more thing. I do want to thank everyone for joining us today. We are going to be, conducting more of these webinars. We really hope you enjoyed it today, found it informative. We're hoping to put together another more in-depth webinar that's going to be discussing the SR&ED program, as well as some other government benefits, grants, and incentives that they have available to help out entrepreneurs and small businesses and whatnot. And then we're also going to do another series on advanced tax planning. So do stay tuned. We're hoping to have webinars every 1 to 2 months. But now, just jumping into some of the questions that have come up over the course of today's presentation. So I believe it's Liesl Jansi that's asked a couple questions here, but we're going to start from the top. If an incorporated business sells some of its assets, will that also be exempt by the lifetime capital gains exemption? That's a great question. So unfortunately, the answer is no. In order to take advantage of the lifetime capital gains exemption, you must be looking to sell the shares of your business, right? There are a number of tests that must be met in order to qualify for this exemption. And, typically it has to be shares of a private corporation, a Canadian controlled private corporation rather, for that matter. And, if this is something that you are thinking about, if you're looking to sell your business, we do have to caution you that some of these tests to qualify for this exemption, they do come into play up to 2 years prior to the sale. So you do need to start these discussions with your accountants, with your lawyers, well in advance in order to make sure that you're able to tap into this lifetime capital gains exemption. Hassan, you had mentioned it was about $1 million. I think that was in 2024, and now it's even gone up a little bit further to about $1.25 million that you can sell the shares of your business, right, per person in Canada. So it's quite a powerful tool. And if you imagine a business owner who's structured it where they have 4 shareholders of their business, let's say I've got myself owning some shares, my wife, my kids owning shares, both my kids, that's 4 shareholders, 4 exemptions at $1.25 million means we could sell our shares of our business respectively for up to about $5 million without paying any tax on it, assuming you've structured it in the right way, right? And that's the kind of stuff we're going to be talking about in our next webinar about advanced tax planning. So hopefully that answers your question there, but generally again, no, you can't just sell assets and tap into this lifetime capital gains exemption. It has to be the whole business and the shares of the business as well. Imran had a question. What is the bottom line amount of the salary or dividend paid to the company shareholders? So I'm not quite following the question there, but sometimes people want to know how much money can I take out of my business without paying any tax or minimal tax. Usually the first 40 to 50K of dividends, there's very minimal tax. I think it's only an Ontario employee health premium tax that you end up paying, which is like typically $500 or $1,000 on the first 50K, if that's what you're referring to. Another good question came up. If you lend money to the company by incurring expenses in your personal capacity, is there a time frame with which the company must repay you? What if it's a startup and it's not generating any revenue, right? So that is common that shareholders particularly are often injecting money into their business. There's no specific time frame as to when that business loan has to be repaid to the shareholders, right? So it could take 1 year, 2 years, 10 years. And over that course of time, any money that you have lent into the business, you are eligible to take back tax-free from the business as a return of your shareholder loan. There's going to be no tax on that withdrawal, and there's no limit to how long how much time you have to wait or must pass before you can take that back. Someone has asked a question, what if you conduct business calls from your car? I wouldn't necessarily consider that to be like a home office or anything, but I'm not necessarily sure how we would be able to justify that. You can consider that business use of your call, but usually business use of your vehicle, again, is driving to and from meeting, various business vendors and things like that. So we may not necessarily consider that business use of your vehicle. And one more question that's come up here about the purchase of a vehicle. Why would the corporation not buy the automobile instead of lending it to the shareholder to buy it in their personal capacity? So typically we do recommend, so why would the corporation not buy the automobile? Oh, I see what you're saying. Instead of lending the money. Yeah, you know what? You're right. In most cases, I do recommend that the corporation purchases the vehicle directly, just because particularly nowadays where we have that accelerated write-off. If you may recall, I was mentioning that you can write off up to 75% of the purchase price of that vehicle or that capital asset if it's purchased through the business. If that asset is purchased in your personal name, you may not be able to take advantage of depreciating or capitalizing that asset in the name of the corporation, right? So that, I think, covers most of the questions that have come across. Hassan, is there anything else you see here? Anything else you want to add to any of the comments that we may have seen or made?
Not specifically. I'm just trying to see. No, I think you covered them really well, Junaid. Thank you. Thank you so much on that.
Well, thank you so much for joining me here today, my friend. It was a lot of fun. And
Absolutely.
Again, thank you everyone for joining us, taking time out of your busy schedules to have us with you today. We hope you enjoyed and learned something from today's presentation. If you do have further questions, please feel free to reach out to myself, Junaid, or my colleague Hassan. We're more than happy to field any questions, offline or after this webinar as well. But do stay tuned for future webinars hosted by SRJ. Thanks again for joining us, and we'll talk to you soon. Bye.
Thank you, everyone. Have a good evening. Take care.